My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to continue our discussion of live financial statements. In the previous video, we looked at IBM's shareholders' equity portion of the balance sheet. And in this video, we're going to take a look at a new line company, Google. Okay, so we are talking about shareholders' equity and just the general organizational structure of shareholders' equity and what we can reasonably expect to see in the shareholders' equity section of the balance sheet. In the previous video, we looked at IBM, an old line company, and in this video, we are going to take a look at Google, which is clearly a new line company. And so we can see, first of all, their stock is currently trading at just over $1,000 per share. That's pretty much a milestone in the history of the markets, particularly for the NASDAQ exchange. There have been very few, I think fewer than a half a dozen companies in the history of the NASDAQ or New York Stock Exchange that have had stocks hit $1,000 per share. In any case, that's kind of a little side note there. So I'm going to click on SEC filings as we normally do. And in this particular case, rather than looking at the 10Q, well, you know what, while we're here, let's go ahead and take a look at the 10Q and see what we can see. So I'm going to start trying to figure out which one of these balance sheet links is the correct one, which one will give us the picture of that we want. This will work. All right, so this is Google's most recent quarterly report, and we have to be very careful here. Google does something somewhat unusual, actually very unusual, and that is they move left to right forward in time. Notice here that the left column is December 31st, 2012, and the right-hand column here is the end of the quarter, September 30th, 2013. That's very, very rare. Normally, it's the left column, which is the most recent information or the most current information. So you do need to pay attention to the column headings so that you know which direction the company is going in terms of time. So it's this last column that we're going to be interested in looking at. So we have the complete balance sheet here. We've got assets, liabilities, and I'm going to scroll on down to stockholders' equity. And we can see that there's a lot going on in stockholders' equity. However, we can see that there is a common organizational structure. Remember that capital stock and then retained earnings are typically the first two groups of accounts that are listed in shareholders' equity. And then those are followed by accumulated other comprehensive income, if that exists, maybe treasury stock, if that exists, and then non-controlling interests if that exists. Now, there is some discretion in how that all gets put together, and we see that Google has once again gone away from the standard sort of organizational structure. They do list their capital stock first, and then they have accumulated other comprehensive income, and then they have retained earnings. Notice that they are not listing any treasury stock, nor are they listing any non-controlling interests. All that tells us is that they simply do not have any treasury stock. Google has not gone into the market and repurchased any of its own shares of stock, nor do they have any controlling ownership interest in subsidiaries for which they do not have 100% ownership. When Google buys a subsidiary or buys a company, they buy the whole thing, not 90% or 85% or 95%. They just simply go out and buy the whole thing. That's a little bit different from what we saw on the IBM balance sheet. All right, so capital stock. First thing that we notice here is that Google actually has a much more complex capital structure than IBM does. Google has actually 4 classes of stock. The first one listed here is called convertible preferred stock. Preferred stock is typically a stock that has preference with respect to certain characteristics. Most commonly, they get preferential dividend treatment. We'll get to again to the details here later on and talk about what the characteristics are of preferred stock versus common stock. But for now, we can see that they in fact are authorized to issue some preferred stock. They're authorized to issue 100,000 shares, but no shares are issued or outstanding. And so those are 0. Even though there's nothing issued and outstanding, they are still required to disclose the fact that they're authorized to issue this preferred stock. Again, that's somewhat unusual. Usually when accounts have 0 balances, they're not presented on the body of the balance sheet. However, shareholders' equity represents the owner's interest in the company, and so they do get a little bit of preferential treatment with respect to certain kinds of disclosure. All right, where there's most of the activity in terms of shareholders' equity, at least as it relates to Google, is on the common stock. They have 2 classes of common stock, Class A and Class B common stock. And once again, we have to be informed how many shares are authorized and how many shares are actually issued. And so it takes a little bit of time to sort through this. So they've got Class A and B stock and their additional paid-in capital. Par value is 1/100th of a cent per share. And let's see here. They are authorized to issue 12 million shares of stock. Class A stock, they're authorized 9 million shares. Class B stock is 3 million shares. And then we're told how many shares are issued. And the first set of numbers relate to what happened at the end of 2012. And then the next set of numbers here, this last set right here, tells us what's happening as of September 30th. So as of September 30th, there are 334,000 shares of stock issued and outstanding, 276,000 shares of Class A stock, 57,000 shares of Class B stock, and then we can see how much par value is in there, and then the rest of the dollars here would be this additional paid-in capital. Once again, we'll get to what par value is versus additional paid-in capital a little bit later on. But for right now, we can see that the dollar value of the investment in Google from its owners is just over $25 billion. I think everything is, yes, everything is in millions, except share and par value amounts, which are in thousands. Okay, so that changes the scale a little bit. So we have $25 billion of ownership interest, and we would have to add thousands to all of this. So it's not really 276,000 shares issued, it's 276 million shares of Class A stock outstanding, because we're told at the top of the balance sheet that everything is per share and share information is in thousands. So this is 276,000 thousands, which is 276 million shares. Now, the difference between Class A and B stock just means that they've got 2 different classes of stock with differential treatment in terms of certain characteristics. If we were to look at the footnotes to the financial statements, we would see that Class A stock is what's actually traded on the stock exchange. Class B stock is owned by the creators of Google. There were 3 or 4 people that created Google, and they own 57 million shares of Class B stock. The other twist here for Class A and B stock as it relates to Google is that Class B stock gets 10 votes per share when it comes to shareholder items, whereas Class A stock only gets 1 vote per share. In other words, even though Google is a publicly traded company, it is still controlled by a very small group of individuals. Whoever owns these 57 million shares, since they get 10 votes each, that would far outweigh the 1 vote each for Class A stock. And so when it comes to shareholder meetings, when it comes to voting for board of directors, when it comes to hiring the CEO and so on, Google management is clearly still in control of the company. But they are getting the advantage of being able to tap into the secondary market for public trading purposes. And now we can also see that they've been authorized to issue Class C capital stock. Specifically, 3 million shares have been authorized. Once again, nothing is outstanding at this point. That's probably just a plan for what they want to do in the future. Maybe they want to raise additional capital in a slightly different way than how Class A and B stock is structured. Or it could be that they're planning on issuing stock dividends of some sort. A lot of times a company will use a different class of stock when they are anticipating stock dividends to be distributed rather than cash dividends to be distributed. But that's their capital stock. So they have preferred stock, the couple of different classes of A and B stock outstanding, and they've created this new class of stock, Class C capital stock, in anticipation of something happening in the future. Then we have AOCI, $538 million in accumulated other comprehensive income. Oh, I'm sorry, $99 million of other comprehensive income. The right-hand column is the most current column. And that's a significant drop from what they had at the end of last year. Maybe they've experienced some AOCI losses or amortizations or whatever. But in any case, that's still $99 million positive. And then, of course, the big number for Google is retained earnings. And we can see that retained earnings is both large and growing. They are a highly profitable company. So they have $58 billion of retained earnings right now. And that is their sum total of shareholders' equity. So they have a total of just under $83 billion of shareholders' equity. That is a rather substantially large shareholders' equity balance. Now, while we are here on the balance sheet, one of the principal, most fundamental measures of financial status is the debt to asset ratio. Now, if we think about it, remember that the balance sheet is assets equals liabilities plus shareholders' equity. So if you can envision, if we look at the value of liabilities in comparison to total assets, we'll get a percentage. What's left over is shareholders' equity. And so we can look at either the debt to asset ratio or the equity to asset ratio. Those are just opposites of the same concept. How much or what proportion of our assets are financed through debt, and what proportion of our assets are financed through shareholders' equity. So let's take a look at the equity to asset ratio here for Google. Our total assets add up right now to the $105 billion. Our total assets are $105 billion, and that is equal to our liabilities plus shareholders' equity. I'm going to bring my calculator in here. And so if I want the equity to asset ratio, I can just take $83 billion, or 82.989, and divide that by the 105,068. 105,068. And we can see that the equity to asset ratio is 79% for Google. That means that their debt to asset ratio is about 21%. So 21% of Google's assets are financed through debt, and then 79% of their assets are financed through equity. That is an extraordinarily high an extraordinarily high equity to asset ratio. That we just don't see very often on a balance sheet. That is just virtually unheard of. If we were to look at other companies' balance sheets, in fact, it would not be at all atypical to see the reverse, where 80% of the assets are financed through debt, leveraged, versus a 20% equity to asset ratio. So Google is very unusual in a number of respects, in particular in terms of their financial position. They are a very low leverage company. Leverage has to do with the utilization of non-equity sources of financing, in other words, liabilities. And Google just doesn't have that much in relative terms, just doesn't have that much with respect to liabilities. All right, so that's a quick overview of Google's balance sheet and a little bit of analysis. Again, one of the most fundamental measures of financial status is either the debt to asset ratio or the equity to asset ratio. Debt to asset ratio is probably more common. It is sort of the standard means of measuring the relative leverage of a business.